our faculty lecture series. Before we start, I have a couple of announcements. First of all, there's an email list for reminders of future talks, and you can find it in the front here. And so if you would like to have email reminders, please put your name and your email address, and we'll send you an email probably about a week before, the Friday before our next talk, if you're interested. If you have signed that before, but you have not received an email, please sign it in again. There are a couple that sometimes can't read the writing. And then our next talk is going to be in 2 weeks, Wednesday, November 30th at 7 o'clock, and that'll be titled Holiday Molecules by Dr. Marty Jones. He's here, so that should be a really fun and entertaining talk. There are some flyers there, so feel free to pick up a flyer for your own purpose, or if you want to hang it up someplace, it would be great too. So tonight's talk is by Dr. Jeanie O'Loughlin, and she's an assistant professor of accounting, and the title of her talk is Cooking the Books, Fraud in the Workplace. Welcome, Dr.
Okay, so I want this to be interactive. If you have a question at any time, stop me, don't wait. If there's something you want me to clarify or ask questions about, please feel free, because I enjoy that, and it'll make it more fun for me and for you. So stop me anytime. So mainly what I'm talking here is occupational fraud. So if someone comes into your business with a gun, that's not occupational fraud. That's burglary or breaking and entering or whatever. So what we're talking about tonight is occupational fraud. And this is where someone uses their occupation, the position that they're in within an organization, to defraud the company. And these are some of the legal terms as far as prosecuting perpetrators. It's their own personal enrichment. So that's one of the things they look for. It's deliberate. So we're not talking about someone who makes a mistake. We're talking about someone who does something on purpose. And then they're misusing or misapplying their employers' resources. So that's what we're talking about for occupational fraud then. Okay. So what I'm going to be talking about is statistics that come out every 2 years. This is the report to the nation, and it's put out by the Association of Certified Fraud Examiners. And they do this every 2 years, so this was their 2010 report. And these are cases that are actually reported by the CFEs, the Certified Fraud Examiners, that actually did the cases themselves, that investigated the cases. So this has 1,843 cases.
Will it cover both corporate and nonprofit?
Absolutely, yeah. And so that's what we're going to look at. Who's committing the fraud? How they're committing it, and just some information about the different kinds of perpetrators out there. So again, this is based on 1,843 cases worldwide, so it's not just the United States, it's worldwide. And this was from January 2008 to December 2009, so that was the time period that we're looking at. So this is kind of hard to see, I guess. The geographic location, so you can see most of these cases are in the United States. But even some of the cases that are in other countries could be U.S. companies. So what they did is they made the company or the geographic location where the fraud was actually committed. So you could have Walmart in China, and if there was a fraud that was committed in China, it would be listed as China, not in the United States. But it just kind of goes to show that it's not just the U.S., there's fraud everywhere. So. Now, types of organizations, so to answer Jan's question there, these were the statistics of the companies that had fraud committed. Private companies, 42%, public companies, government, and the little tiny one down there, not-for-profit. Now, although that looks like a small number, my experience has been that nonprofits don't like to talk about fraud. And I've worked with a couple of nonprofits, and I encouraged them to prosecute the person. But they didn't want to, because they said, you know what, if this gets out, then people will think that we don't know how to take care of the money, and they won't give us money anymore. And so a lot of times what happens is someone will commit fraud, especially at nonprofits. They'll leave the nonprofit and they go to another nonprofit and do the same thing again. I was working with a church, a pretty good-sized church in Oregon, and they had a woman who had only been with them like 6 months and took about $80,000 in that short period of time. And so I told them, I said, you know, you really should prosecute. And they decided that they didn't want to do that. And right after this happened, they got a notice from the district attorney that she had a garnishment on her wages. And I kind of wondered if maybe, you know, she had perpetrated a fraud somewhere else and the garnishment was just now coming through. Of course, they don't know what the garnishment is for. They just knew that there was a garnishment coming through. So that's the percentages there. Now the sizes, you can see it's not quite evenly split, but it doesn't matter if you're small or large. You know, fraud happens everywhere. Nobody's safer than anyone else there. Now distribution of losses, and this is kind of hard to see, but this is 100 to 500,000 here, and then this is $1 million and up. So you can see the losses are pretty great for most of these companies. And then the median loss for organizations. So again, private companies have the largest, but look at the not-for-profit. So think about the not-for-profit organizations that we have in our community. How many of them could afford a $90,000 hit? So even though it doesn't seem like it's that much money, it's relative to nonprofits. So for nonprofits, $90,000 probably puts a lot of nonprofits right out of business. That's a lot of money. Government organizations, a little bit less. Public and private companies are the ones that get the bigger hits there. Now, again, that's kind of hard to read. These are just some of the different industries that they looked at. And if you look at mining up there, they were that was the one.
Turn the lights up?
Would that help a
I
little?
think so. Yeah,
Is that,
yeah, it does help.
But I don't think you have to have them all.
okay, so that's, is
Here,
that,
that's better. That way we can still see.
so you can see in the mining industry, they didn't have as many cases, they only had 12 cases, but look at the median loss, $1 million. You know, so mining, you could think about gold mines. It's too bad Rob's not here tonight. You know, mining is a lot of different industries. So their median loss is the greatest, but they didn't have as many cases. So healthcare, banking, pretty much any industry. There's no industry that's really, really safe. So the occupational fraud categories, these are the three main categories that we look at with fraud. Asset misappropriation is probably the ones that we think about most. So assets are things like cash, accounts receivable, inventory. Those are assets. Corruption is where you're using your influence to benefit yourself. And then financial statement fraud. So financial statement fraud would apply mainly to larger companies then. So now when you look at the dollars, the method, you can see financial statement fraud is less than 5% of the cases. But look at the median loss. So when we talk about financial statement fraud, we're talking about an organization that misstates their financial statements, and we rely on it, invest in the company, and lose money. So that's financial statement fraud. And that's why the loss is so big. And of course, the majority of the cases are asset misappropriation. So people stealing money, inventory. I worked for a manufacturing firm many years ago, and they made filters. So they made filters for like HVA systems, train locomotives, so they made big filters. And they used aluminum for the frames. Well, we had a shipment of aluminum come in, and when it comes in these great big long, you know, like 25-foot length pieces, big semi-truck. So it takes up a lot of space and you can see it. And 3 days later it was gone. So it was definitely an inside job because the building was secure. But that's an asset loss. That was inventory and that was assets. Okay, so when we look at cash misappropriations, almost 84% of the asset misappropriations are cash and the others are non-cash. An example, I was working on an audit in Sacramento. They have a big jazz festival every year in Sacramento. And a lot of the money that comes in is cash. So they have, it's a whole weekend event, and they have cash for parking. So they have parking places all over the city, and people pay cash for the parking. And they pay cash at the beer tent, and they pay cash for food. And they really didn't have very good controls of cash. And cash is one of the areas that you need to have the tightest control, because one of the things a fraudster has to do when they steal non-cash is they have to be able to convert it to cash. So whoever stole that aluminum or stainless steel, they have to turn around and sell it. But if you can steal cash, you don't have to do anything. It's already cash. So you have to be so careful when you have cash. And you can see that's where the biggest percentages are.
How can you track the misappropriation of cash?
Well, depending on the situation, some of the things that we were looking at trying to get this jazz festival to do is to even have numbered tickets for parking. So when someone comes in to park, you have numbered tickets, and you give the person, you know, X number, and you know that you gave them tickets, you know, 100 through 500. So then at least you can watch the numbers to see if you sell 500 tickets but you only have $400, you know something's wrong. So that's one way. You'll notice if you're in places like Walmart and banks, you know, they've got cameras around. So it kind of depends on what type of business you have. Another thing, how many of you have ever been in a restaurant where it says, if you don't get a receipt, your meal is free? That's an internal control procedure. Because if I see that and I don't get a receipt, then I'm going to ask for my free meal. And then they have to get the manager involved, and then they're going to want to know why you didn't ring up that sale. So that's another way that people take cash, is they don't ring up the sale and they put the cash in their pocket instead. So there's a lot of things that you can do. It depends on what type of cash that you have and what type of organization it is. But cash is the thing that you have to be most careful of because it's already cash. You don't have to convert it. Okay. Okay, so then some of the subcategories under asset misappropriation: theft of cash receipts, and we have skimming and cash larceny. Now what skimming is when you take the money off the top before it's ever recorded. So if you have a cash register situation and somebody comes in and buys whatever it is you happen to be selling, and the person at the cash register doesn't ring it up, or maybe they ring it up but they don't put the cash in the register, they're skimming it right off the top before it gets recorded. So cash larceny is when they actually record it, or it's recorded, and then they take the cash out. So it's both a theft of cash, it's just whether it's been recorded or not. And so you can see the skimming is a little bit higher than the cash larceny, because if you can get the cash before it's recorded on the books, that's easier to hide than if you have to go and try to figure out a way to hide it after it's already been recorded. And then you can see the cash losses. So for skimming is about $60,000 and larceny is $100,000. And then the non-cash, we get into the fraudulent cash disbursements, billing schemes. There's all kinds of billing schemes where maybe you have a billing clerk who sets up a dummy company and then makes up, and part of the problem too is nowadays with computers you can make beautiful invoices, you can design logos and make up a company and it looks legitimate. So that's some of the billing errors then, that people will set up dummy companies, make up invoices, and then have it sent to a P.O. box, and then they pick up the checks and cash them. So that's a billing. Expense reimbursements are another hot area. Any company that does any kind of reimbursement That's something that you have to watch very carefully. People pad their expense accounts all the time, and it's really interesting some of the creative ways that people do that. You know, they'll actually put together a trip and not go on the trip. And I think it's probably more prevalent in larger companies, because here at Adams State, I know if I said that I went somewhere and I didn't go, everyone would know that I didn't go. But in a huge organization, you might not be able to tell that. Check tampering, that's another scheme where people actually tamper with the check. So maybe what happens is they have a check made out to Adams State. So instead of putting Adams State College, they would make it Adams State, and then maybe they can set up a bank account where, as long as it just said Adams State and not Adams State College, they could deposit it into their account. Or they'll add a name onto it or something like that. So they're actually tampering with the check itself and changing something on the check. And payroll is another one that it's really important to have good controls. And a lot of times what companies do is they have human resource and payroll together. And that is not a good situation, because what happens if you have the same person doing both of those functions is you then give them the ability to set up a ghost employee and pay that employee. So usually you have those as two separate functions. Human resources will set up, if you have new employees, the human resources sets them up, and then the payroll department, that's a totally separate function, pays them. That way you kind of protect yourself against that ghost employee. So that's what mainly you see with payroll is ghost employees, or the opportunity to change timesheets or time cards or pay. So that's why you want to make sure you keep those separate. I was working for a small nonprofit a few years back, and one of the problems with nonprofits is that most of their funding goes towards whatever their mission is, and that's the way it should be. But unfortunately, what that usually means is they shortchange the administration side. So I was working for a nonprofit, and I did it all. I was the director of finance, and I did everything except I couldn't sign checks. That's the only thing I couldn't do. And so they decided that they would outsource payroll to ADP, which is a big payroll organization. So we would call in the time, send them all the information, and they would print the checks and they would deliver the checks to me. And then I would give them to the other supervisors, and they would hand out the checks. Well, one week, we got paid every 2 weeks. They called me up and said, the checks we just sent out were wrong. We used the wrong withholding tables. So shred those checks and we'll send you out new ones. Well, that's no problem, except I could have very easily pulled my check out of that batch and got my second check, because guess who also did the bank reconciliations? So that's what happens in nonprofits. And I see this all the time. You have one person that does everything. And part of the thing about fraud is what we call a fraud triangle. Has 3 parts. So the first part is you have some kind of a pressing need. And usually it's something that you feel that you can't talk to anyone else about. The very first fraud case I ever worked on was a man who was a bookkeeper for his church. Well, he was a bookkeeper. He had a bookkeeping business, and he was a bookkeeper for his church. And he'd been the bookkeeper for the church for years and years and years. Well, he had one child, a daughter, and she was getting married. And he really wanted to give her the fairy tale wedding that she wanted. But for any of you who have gone through weddings, they can cost a lot of money. So he thought he would just borrow a little bit from the church, and then he would pay it back. So he didn't intend, most fraud you'll find, people don't go to work for a company and say, oh, I'm going to steal from them. Here was his need. He really wanted to do this for his daughter. And he didn't feel that he had any other option, any other way to get this money. So he was just going to borrow it. Well, it got to be $60,000, and he couldn't pay it back. And so they finally found out and prosecuted him. But that's the first part of the triangle, is that you have some kind of a pressing need. For a lot of people, the need is drugs, gambling, lifestyle, power. So that's the first part of the triangle. The next part is to have the opportunity. So in business, what we want to do is try to minimize that opportunity. So if you have the need and you say, oh wow, I could take that money, I could borrow it. So he knew that he had the opportunity to take it. And then the third part of the triangle is rationalization. So once you commit the fraud, then you start rationalizing it. Especially in nonprofits, the rationalization is usually, they don't pay me anything anyway. I've earned this, I deserve it, I work hard, I've put in lots of hours. I've been with this company for 10 years. So that's the third part, is then you start to rationalize what you've done. So that's what we have in our fraud triangle. And I don't remember how I got on there, but so for payroll, again on payroll, that's what I was thinking of. A lot of times if you have the opportunity, what you can do is raise your own salary. So maybe you're making $15 an hour and you say, you know, I really need to make $20 an hour. And if you have the opportunity, you could go in and change your salary, and you just gave yourself a raise, and maybe you can get away with it for a while, maybe you can't, but you have the opportunity and you may or may not take it. So we want to make sure that we minimize those opportunities. Cash register disbursements, a lot of those involve other people. So you have someone that comes in, your friend comes in to buy something, and either you ring it up at a much lower price, you know, maybe they're buying a coat, and instead of ringing it up at $80, you ring it up at $20. Or maybe you ring it up at $80 and they give you $20 payment and you give them $50 back. So now you just took money out of the cash register. So those are scams that occur if you have a cash register and around the cash register situation. And then some of the other ones are just cash on hand and non-cash. So cash on hand, I had a company, I used to have to go up to Sacramento every other week and audit one of our plants up in Sacramento. And we had an office manager up there who had a petty cash fund, so petty cash. And the way she kept track of her petty cash is I would go up there and I'd say, okay, Tracy, I need to audit your petty cash. And she'd say, well, it's in the drawer. So she had a desk and her top right drawer was petty cash. And her drawer was never locked. And she would just throw all of her change in there. And she had like $150 in petty cash. So she never kept track of it. Anybody could go in there. But because she was always worried about not having enough, if she went and bought a candy bar, she'd throw the change in that drawer. So usually her petty cash was way over rather than under, but there was no accounting in there. You never knew what she'd spent the money on. There was, you know, no accountability for it, but she just made sure that she always threw cash in that drawer. And then non-cash could be things like inventory. That's probably the most common.
Jeanie, out of that list, which one carries the highest penalty?
You know, that's a good question. The problem is that it's so inconsistent. So I was looking at a fraud casebook that I have that has about 65 different cases. And one of my favorite cases in there is two women who were secretaries and embezzled $11 million. And neither one of them were prosecuted. Well, they tried to prosecute them, but they never got any time. And then there's another case where someone stole $20,000 and got 6 years. So, you know, there's no consistency, and I think that's part of the problem. There's no consistency in penalty at all.
Under the fraudulent cash disbursements, which one of those, out of those four, which one is more common, like in big corporations?
Well, you can see the percentages. So here, the billing would be the biggest ones. And that would encompass all the companies.
Oh, I see. Okay.
So yeah, I'm not sure if they broke it out by the different companies or not, and there's a lot of billing schemes. You know, you set up shell companies, and you know, you pay yourself, and some of the people are really funny. They'll go in with the billing schemes, and they'll deposit the check into their own personal account. So one of the audit tests that we do is to look at payroll bank accounts and vendor bank accounts. And if you have a vendor and an employee that has the same bank account number, that's kind of a red flag. So that's not a very smart crook there. And to me, this is the part that's kind of scary. how do we detect fraud? The biggest thing is tips, people calling in. You know, for big companies, they have to be audited every year, but an audit is not designed to detect fraud at all. And everybody thinks it is, and it used to be when accountants were first auditing, that's what their function was, to audit for fraud. But that's not the main objective of an audit anymore. So the main way that we detect fraud is by tips, by people calling in. By accident, look at almost 10% are just by accident. So external audit, look at that, 4.6%. And that's what most of us, when you look at audited financial statements, that's one of the things that we kind of expect. Oh, these statements were audited, so there must not be any fraud. But that's not the purpose, and it doesn't happen very often. So there is actually 1% that people confess. So there are some theories out there that at a certain point in time, people want to be caught. You know, that maybe this has gone on long enough that they're ready to be caught. So, but that's not a very big percentage there. So.
What is the management review?
Well, now with Sarbanes-Oxley, that was passed in 2002 after the whole Enron, WorldCom, all of those big cases. Management, one of the defenses that Ken Lay used was, I didn't know what was going on. And so now, with Sarbanes-Oxley, management has to do a review. They have to take responsibility for the internal controls, and they actually have to do what's called an MD&A, a management review and analysis that they have in their financial statements, and they have to sign off that they have reviewed the internal control and that they are responsible for it. So it's actually put more liability onto managers, so they can't take the I didn't know what was going on defense. So,
I have a question.
uh-huh,
The confessions,
yes.
what are the reasons people confess? And one is that, oh God, I just feel so guilty, I have to confess. But are there other reasons?
I don't know. That's the only thing I've seen. They had the Association of Certified Fraud Examiners has some videos that they've done. And there's one video that I was watching about a man who's actually making a confession. And that's what he said. You know, he said, I just can't keep this going. Because if you think about it, depending on the kind of scam that you're running, you know, it takes a lot of work to keep it going and cover up your tracks. And, you know, if you're doing a kiting scheme where, you know, Ted sends in his payment and I apply Ted's payment to James's account, and then Jan's payment comes in and I have to post it to James, and you're constantly covering all the time. And to me, I think it would just cause me so much stress, I'd go crazy. But, you know, so it is a lot of, you know, it takes a lot to keep on top of that. Some of the ways they find those kinds of problems, and you know this with banks, especially banks will make you take 2-week vacation. If you have someone who never takes a vacation, that's a red flag, because that's the way you're going to detect that type of scam. Because if they're on vacation, somebody else has got to step in, and they're going to be taking those phone calls. Hey, I made my payment. How come you didn't credit my account? And then you look up and say, no, you've never made your payment. And they say, wait a minute, here's my canceled check. So that's the way a lot of fraud is detected too, is by making people take vacations. And it's funny because, you know, a lot of times what you have is a very dedicated employee, and you trust that employee because they're dedicated and they're always at work on time. You know, they're never gone. And those are the ones that you kind of have to watch out for because they can do this. We had a case once where it was a secretary. It was in a college, and she was a secretary of a department. And it was a small department. There were only about 4 people in the department. And what happened was she had a baby. And so she was going to be off. And she told the department, it was a small town, and she said, don't worry, I'll come in and take care of everything. You know, I'll come in every couple of days and keep things going. Well, while she was gone, the faculty of the department saw these invoices come in. And she saw an invoice come in for a 4-drawer file cabinet. And it was a small department, and she said, no, I don't think we got this. So she called up the vendor, And they said, oh yeah, and we delivered it to such and such an address, which was her home. But had she not been on leave, and then what we found out is she had been forging the faculty member's signature, and she did it very well. I mean, you really couldn't tell that it was a forgery until you really started looking at it. So that's what she'd been doing. She'd been ordering stuff because she had a little business going at home. And she had been ordering stuff, and then she had been signing the faculty member's name, and she had the budget so she knew how much they could spend. And she had been there, I think this had been going on for about 2 years. So, and had she not had the baby, I don't know how much longer it would have gone on. So, okay, so what I find interesting is that sources of tips look at 12% from vendors. Now, if you think about it, it would be kind of hard for a vendor maybe to give a tip, but what we find is that you have competition. A lot of times if you're doing a competitive bid process and someone gets a bid and they think, wait a minute, how did they get that, or how did they bid that so low? And they will call in and say, you know what, I think something's going on here. Customers also. So customers are mainly when you have this check kiting scam, and they'll call up and say, you know what, why is it that my bill is always, or my check is always being posted a month later than when I make the payment? You know, so those are the kinds of customer calls that you'll get. How many of you, when you get a statement, you know how you send your check with it and it'll have a place to write the amount that you're sending? Does everyone always fill that in? That's an internal control also, because a lot of times what will happen is you write, let's say that you're making your credit card payment and you send them $100, but you don't put anything on that little piece of paper. The person that opens the mail can put $25 on there, and then they can put the other $75 into a different account. So make sure that whenever you send in payments that you always write in the amount that you're sending on that piece of paper. So a look at anonymous tip is 13%. And tips from employees, that's the main thing. Because usually if something's going on, somebody knows about it. It'll depend on whether or not they're willing to cop on it or not. But that's where most of the tips come from, is employees. And it can be from top to bottom. You know, some of the frauds are committed by the guy at the top. And I say guy because we'll go through and look at gender here pretty quick. But, so someone working for them, you may have a situation, especially in financial statement fraud, where you have someone higher up who's telling someone that works for them, fix the books, or make this entry, or we've got to meet this projection, this sales projection, or we've got to make this net income projection, whatever. And so they're telling someone who works for them to cook the books. And a lot of people, you know, it's very easy to say, oh, I would never do that. But you know, if you're making a good salary, I was just reading an article a couple of weeks ago that's talking about CEOs versus CFOs. So the CEO is the chief executive officer, is a person at the top, and underneath that CEO you have the CFO, the chief financial officer, who takes care of the books. So if you're making, you know, $300,000 or $400,000 a year, and you've got the CEO that comes down and tells you, we have to meet this projection, and you say, but we can't do that, and they say, you will do it or you're going to walk, and you've got a family to support, sometimes it's not easy to just say, forget it, I'm not going to do that. So those can be very tough decisions. It's ethically, it's wrong, but you know, we all have other things, you know, families that we have to think about as well. So sometimes it's not as easy to make those kinds of judgment calls. But again, that's the biggest thing, is from an employee that sees something that's going on that says, nope, I'm going to call and report this. Oops. So, position. Employee just means an employee, so probably many of you and I. A manager and the owner and the executive. So if you think about it, why would the owner steal from themselves? Taxes. A lot of times, they say, hey, it's my money. I'm the owner of the company. It's my money. Why shouldn't I take it? But a lot of times what you're looking at is financial statements then. that they're messing with, that they want to pull the cash out but not report it on their financial statements. And maybe they're in the process of getting a bank loan or buying a new building or expanding or whatever. And a lot of times what that refers to then is taking stuff off the books. And notice the biggest loss. So the higher up you go, the bigger the loss is. For the average employee, it's $80,000. But once you get into manager and owner and executive, it's much larger amounts. Okay, so there's our gender. About a 2 to 1. And notice the loss is about 2 to 1 also. So males are about 2/3, and then the median loss is about $232,000. Now the department. If you think about it, where would you think most fraud would occur within an organization? Accounting. So accounting is up here. That's the biggest, 22%, but you notice it's not the biggest dollar amount. So if you look at there, if you, again, talking about the people at the top, because they have the power to, ask their employees to do certain things. So there's where your median loss is, the largest loss, even though it's not necessarily the biggest percentage. So all over finance, it doesn't really matter. HR, and again, your HR, a lot of those losses are from setting up ghost employees and paying people that don't exist.
How come the dumb internal auditors can't do any better than that?
Yeah, just a measly $13,000.
I'm surprised to see the board of directors on there.
Yeah,
Usually the board doesn't have anything to do with the actual finances of the company other than oversight.
mhm. Yeah, I'm not sure what all frauds they would perpetrate, unless it would be more personal nature where they're maybe not
Influence.
disclosing conflicts of
Yeah,
interest and they're
yeah.
doing business with their own companies or
Could be.
something like that. So.
I got a question on, I noticed a lot of the high numbers have to do with the executive and the very high levels. Has there been any studies or interviews or interrogations of these people as to their motivation? I mean, they're already being paid more money than what they're ever worth. And now they're going after even more money. And it just seems like,
Well, the cases that I've read, well, it's like the Bernie Madoff. I mean, it gets to be a power thing, and they want more and more. One case I was reading about, this man he just wanted a lavish lifestyle. He bought this house, and he had, landscaping, just millions of dollars in landscaping, and that's what he was taking the money for, is for his lifestyle. And the same thing with Bernie Madoff. My gosh, that man had plenty of money. But some of the things that they've been auctioning off of his, the $250,000 cufflinks or something. I mean, it just gets to a point where I think it's just pure ego at that, and power and control at that point. We were talking I teach accounting, and we were talking today about winning the lottery because we're doing present value, and we were talking about the difference between, when you win the lottery. If it's a $200 million lottery, they don't give you a check for $200 million. You either get annuity payments of, $10 million a year for 20 years, or you can get a lump sum, but it's going to be less than that. And someone said, well, why couldn't you just live on $10 million a year? And I said, well, I think I could, but a lot of these people, it gets to be a power thing. They have the opportunity and they want more and more and more. A lot of them too are drugs and gambling. And I think that was the housing authority here in Alamosa. Wasn't that one of the things I think I read in the newspaper, is that there's a gambling problem? So those are some of those motivators. If you have a gambling problem, you can't go to the bank and get a loan for that. So you've got to find some other way, and if you have the opportunity, then it's easy to dip your hand in the till there. So. But you can see, nobody's exempt. Regardless of what department, fraud can occur anywhere. Okay, so length of time employed. You can see a few of the frauds are for new people, less than a year. But again, here's where we've got the big part here, and these are people that you trust. Again, you can't commit fraud usually unless you're in a position of trust. And you're in a position of trust because you've been there a while, you've done a good job, you never take vacations, and that's your biggest opportunity. And you'll notice too that the longer you're there, the greater the loss as well. So the age, and these kind of all tie together. The age, the position, how long you've been there. Notice the younger people, they're not committing too terribly much fraud at this point in time. But once you get over here, here. Now, once you get older too, you're not committing as much fraud. So at the beginning and the end, but it's the middle part you have to worry about there. But again, the older you get, look at how much their median loss is too. So, but again, these are people who are going to be in higher positions, those executive or management positions, probably been there longer, and have more opportunity. And then the education. One of my favorite cases, I was telling you earlier, they called this case, they named it the Mojo Twins. And these two women happened to go to the same high school. I don't remember what state they were in. And neither one of them were high achievers. They both were like C- students, not overly bright at all. And the one went to work for kind of a third-party insurance billing company. And then she ended up hiring the other woman to work there. They didn't know each other in high school, so they met at this company. And they'd been there for several years. One of them was a supervisor, and one of them worked for the other one. And they were in the testing module of the software that they were using. And they said, you know what, let's see what would happen if we did this. And they thought, well, if we get caught, we'll just say, oh, well, we forgot to erase the test, because apparently they were doing training, and so it was a training module of the system. So they tried submitting this bill, this fake bill, and it went all the way through. And so I think it was a couple of years they embezzled $11 million. But they weren't, I mean, they barely had high school. So you don't have to be a rocket scientist or an accountant to steal. It can happen at any level. The main thing is that opportunity. And being smart enough to say, I wonder what would happen if I did this. Or just watching for a while to say, let's see what's going on, see if I can figure out how to do this. But again, the high school here, the median loss is only $100,000. But again, the higher levels, the higher education, the median loss definitely goes up. Now,
Why do you think it increases from some college to college degree? Like it goes from high school, it's obviously higher, and then it decreases, and then it bumps back up.
well, I would guess that when you get into college degree, now you've got your accountants, your finance people, your attorneys, you've got all your middle to upper management people in your college degree. So here, if you've got some college, you might be a first-line manager, but chances are you're not going to be as high up the ladder as someone who has a college degree.
Maybe it's directly related to student loans.
And needing to pay them back,
Yeah.
right? Yeah. Uh-huh.
Didn't you say with college degree lawyers? That would be postgraduate.
Yeah, I guess that would be postgraduate with lawyers, yeah.
That drops down.
Yeah, except you notice their median loss goes up.
Well, that's
Well, there's less people that have postgraduate.
That's true. So, one of the things that we try to tell employers is to do background checks. But as you can see, that's not really going to help you very much, because almost 86% had never been charged or convicted. And again, that's part of the problem, is companies don't want to push this. It's expensive. They would much rather just have the person leave and put it to bed and be done with it. And the consequence of that is, even if you do a background check on someone, then that's not going to show up because they were never charged or convicted.
And do most companies have any kind of insurance against fraud, so it's easier for them just to file the paperwork, or?
Well, some of them do. You know, a lot of times, especially with nonprofits, what they should do is bond their accounting people. And part of the bonding process would be to do a background check. But again, it costs money, so a lot of nonprofits don't want to do that. And what I have found in my career, my very first accounting job right out of college, I was a staff accountant for a Fortune 50 company. And they did a drug test on everybody. That's the only drug test I've had in my entire career. When I was a budget director and a treasurer of a college, nothing. So, you know, that will detect some, but not a lot. So the problem is that people don't want to prosecute. And then there's other companies that if they have any kind of a fraud, even if it's for $100, they will prosecute it to the hilt because they want to set an example to everyone else. And that works pretty well, because part of that whole opportunity is the perpetrator thinking that they're not going to get caught. And just what we call the perception of detection, if you think that you're going to get caught, that's enough to deter you right there. But if the organization is loosey-goosey and you think, forget it, I could get away with anything here, you know, there's incentive and there's opportunity there. So, you know, there's a lot of things that companies can do, but some of them are just unwilling because of the negative publicity that comes with that. So, but you know, this is kind of sad, because if you did the background check, chances are it would come clean. There'd be nothing there. So, any questions?
Adams State College. Great stories begin here.